The nomenclature is different. It's you kind of feel like a lawyer sometimes because you're analyzing a lot of legal concepts. It takes some effort to get up to speed on that, and it is different than just analyzing a common stock because it's a different part of the capital structure. You're subject to different constituencies, excuse me, that control the process. So yeah, it's hard. It's harder to learn that on your own. I've had the advantage of learning from some of the best over the last 5 years, and it would have been very hard to learn any of that on my own. Unlike most things in investing where you really can self-teach, you really have to do it. You have to go through the process several times to really understand all the moving parts, to understand the terminology, understand the various concepts. That said, there's nothing forbidding about it. Anybody who's smart enough to be a good investor anywhere else in the capital structure could be a good investor in distressed. It's all the same concept. You're trying to buy something for less than it's worth. The beauty of distressed is you have a lot of natural sellers, right? A company defaults, their bonds are going to generally trade way down because there are a lot of people who can't hold defaulted bonds. There are a lot of people who don't have the time and the inclination to go through the process and say, I don't really care what they're worth. Even if they're worth more than today, I just want to sell. I just want out. And so as the reorganization process goes through, you have a natural catalyst to hopefully eventually unlock some of that valuation. You generally can't stay in bankruptcy court forever, so that's a good thing. But yeah, I think it's very important, and I think there are a lot of equity investors probably that would benefit from understanding the credit and distress side, because a lot of value opportunities, wherever it is in the capital structure, come with a credit component. And if you don't understand the liabilities on the balance sheet and you don't understand how cash flow and credit can be impacted down to the equity, that can be something that really comes back to bite you, obviously. So, I think in terms of finding the right opportunities, it's just like anything else. I mean, it comes from experience and from seeing what opportunities have worked in the last 6, 12 months, the last year, the last 5 years, the last 10 years. I mean, really going back and studying all the cases that have been prominent, the good ones, the bad ones. There's no magic to that, I think. I mean, the stuff that you can invest in as a distressed investor tend to be bigger reorganizations, actually. I mean, little companies that are, a few billion or something like that. Those liabilities, those claims don't generally trade on a very liquid basis. I mean, you can, but most of those companies tend to either be sold or go into Chapter 7 liquidation. So they tend to be fairly big companies, the kinds of things where if they get into trouble, if they file to reorganize, you're going to see it at least in the Wall Street Journal or Bloomberg or something like that. So, and the industry's well covered. I mean, it's not hard to figure out, which companies are in or out of distress recently, in or out of bankruptcy court. So finding the opportunities isn't really hard. Now, judging which ones are going to be good and which ones present attractive risk reward is obviously the million-dollar question. And like I said, it just comes back down to valuing something. It's all about valuation. And if you think you're getting a big discount to what it's going to ultimately be worth, great. And you just need to have a very fine-tuned and calibrated approach to what that value is going to be, because there are a lot of things that can go wrong in the process. And if you're naive and you're the dumb money at the table, there are a lot of smart guys in distress that will eat your lunch, and you'll never see it coming. So you have to be careful. You have to learn constantly. You have to learn as you go. It very much helps to learn from people that have been through it before. Again, it's not something that would be easily learned on your own as a, individual guy, with no support and no mentors or whatever. So from that perspective, I guess it's a little bit different. But, when these opportunities are available, you can provide a range of valuations. Say a company's defaulted, you think the senior unsecured bonds are the fulcrum security. You're very comfortable that in a couple of years, when the case is sort of resolved, you're going to be getting a distribution of 70 to 80 cents. The bonds are trading at 40. It's a wonderful thing, right? I mean, those opportunities are rare today, unfortunately, but they do come around. And I think you've seen, and some of the best value investors out there, Oaktree, Baupost, I mean, they're distressed guys. That's what they prefer to do. That's what they do most of the time if they can find it. And those are some of the best investors walking the planet today. So I think there's definitely something to be learned for all value investors from that process.